Good afternoon, everyone. Thank you for joining our webinar series. I know we have people signing in from all over Africa, Nigeria, Ghana, Tanzania, Senegal, Uganda. Welcome, everybody. My name is Tosia Denka, and I would like to, on behalf of Servit, welcome you to the pilot edition of the Setting Up for Success web series themed Structuring Your Business to Attract Venture Capital. As advertised, our guest speaker today is Orbit Shinar, an exceptional leader in her field. However, before she takes the stage, I would like to run us through some house rules, simple house rules. We estimate that this webinar would be about an hour long. There is going to be a brief introduction of Servit by the founder and CEO, Omoni Kolade, right before Ornit Shinar gives her presentation. An interesting Q&A session that would be coordinated by me would then follow after her presentation. I would please like to ask that all questions are sent via the chat window before the end of said presentation. If anything is unclear, please send me a message via the chat window and I will be happy to respond. I think this pretty much covers our house rules. In furtherance, I would like to call on our host, Omoni Kolade, founder and CEO of Servit, to give a brief introduction as to the reason behind this introduction of this web series. Over to you, Yuni.
Good morning, good afternoon, everyone, and thanks for joining our web series. Welcome to this, our median editions of Servit, Setting Up for Success. My name is Nick Ade, and I'm the founder of Servit, and also CEO for Servit. For those of you who haven't heard about us or you're not sure about what we do, Servit is a Pan-African enterprise payment gateway developed for both online and offline businesses, banks, and other market companies. To put it simply, we're in business of helping other businesses, merchants on the continent get paid in the most seamless, effortless, inclusive, and secure way possible. Our
Hi, everyone. Please indicate if you can hear me. You can just send me a chat to indicate if you can hear me. I think we have lost me there for a second, but he will be back shortly. So as I said earlier, please send me your questions via the chat window. And then at the end of Ornit Shinar's presentation, we will be taking the questions and the answers from her. Omoni will be back shortly. I think we just lost him due to some network issues.
On their platform. We'll make it easy. We'll make it very safe because we're building
very... we actually lost you. Hani, we lost you for about 2 minutes, so you might need to start over.
All right, sure. I'm going to pick it up from the value we give to the merchant today on our gateway. One of the key value we give is our robust fraud protection tools and our powerful risk management analysis. And like I said earlier, we've actually built something where we built a payment types and options for different locality. Our focus is to avoid differentiating customers in those localities across Africa. Our platform is tailored to address specific problems in different business segments, verticals, and key areas of the market. Our payment gateway is currently being used by more than 1,000 merchants across 8 African countries today. And we are proud to be contributing our quota to the success of these local and international businesses who are making impact in Africa today. Some of our merchants today are likes of the Ginger, Domino's, British Council, UNHCR, and one of the online biggest streaming movie platform in the world. And the key thing about Servit is Servit, like most of us entrepreneurs and executives on this call, we require to have a lot of information necessary to help our business grow. How do we create and sustain demands for our products and services today? How do we intelligently test to our startups ideas, market, and how to get to our market rapidly? When is the right time you're starting to kickstart business? When is the right time to exit our business? These are some of the questions I know everyone has and everyone would like to understand by the virtue of this web series. We also decided to create this one of the reasons why we've set up this series is actually to help scale businesses in Africa as a whole and give a platform for every businesses to have the single and the most important ideas about how to structure their businesses today. This month, we're privileged to have Onishina, Head of External Innovation and Venture Investing at City Venture, to talk to us about how to structure the business. And we hope by the end of these sections, you'll be empowered with the knowledge to position your business to secure the funding or desires structuring you require. Thank you all. I hope I'll let Tosin take it off from here. Thank you.
Thank you, everyone, and thank you for having me. It's my first time in Africa, and I hope next time I can do it actually live in person and not through a computer, but very excited to meet you all and to hear your questions and see how I can maybe help and contribute to your thought process. I'm going to share, if that's okay. Can you enable my screen sharing? Otherwise, it's fine. I can also do it without the deck. Just let me know. Tosin, is this? Can you enable the?
Okay, we'll sort that out for you. We'll sort that out for you now.
Excellent. Yeah, thank you very much. Oh, perfect. I have it.
I think you can share now.
Yep, I have it. Can you see it now?
Yes, we can see it.
Perfect. Excellent. So we'll start now, and maybe a few words just about me so you know who you're dealing with. So I'm a lawyer by education. I spent, I did a degree in England, in France, and in Israel in law, and then worked in the Supreme Court, and decided I absolutely detested my profession and wanted to do something more fun, where I can win when you win, and I don't need to always try and beat the other to win. We can do something that's more collaborative. And the truth is that I did this move about 25 years ago, and I haven't regretted it once, because this really is a business where I think that the high-tech industry is very much targeting people who are like-minded, who are looking to create new things, that are looking to build together, and are not always looking to one-up everyone else. So this is how I got to where I was. I've had quite a broad experience working both for startups and founding a number of startups. So Sendum and Sanchi are companies that I founded. I worked at CommTouch that went public, and MessageMind got acquired. And then with Sanchi, what I did was a company that I thought was going to offer services to startups, helping them understand how to best engage with VCs, with businesses, talk about strategy, go-to-market, business development, fundraising, you name it. And my first client was Sony. So get bigger clients than you expect. It changed my go-to-market model quite substantially. My second client through Sanchi was Citi, and that's how I got to work where I am today. So, you know, as we talk, we can go into that a little more. The company that I founded is Sendum, the top left company. And that was a WhatsApp-like company that I founded 2 years before anyone had any WhatsApp or anything like that. Of course, the end result is known, right? WhatsApp is around and Sendum is not. But there were a lot of experiences and do's and don'ts that I learned along the way. And so I think it could be very interesting to think about that in the path of what we do. So I'm going to target with this deck something that's quite broad, targeting people who are at the start of their path, but also people that are going further down the path, have an idea, have a product. And so we'll talk about a variety of things. And perhaps the first thing that I'd like to discuss is the idea. So when you have a really good idea, you have to go after that idea. And when you have that passion, that drive, that you feel that you have to go after that idea, you know that you're probably after something good, and it's really time to drop everything else and go for it. But going after ideas is difficult, right? Usually you start and you try something and you try it and you try it, and along the way you go, okay, it's not working. And maybe if you'd just given it that one last try, maybe that was the one that would have made it work. And so it's important to work on your ideas and to cultivate them, and not to give up. And as I'm saying this, part of my brain is going, but if it's not the right idea, just move on. So it's important to think about what you're doing and think about what the feedback is that you're getting in terms of what's not working. Is it something that's technical or incidental, or is it the very core that people just don't relate to the core of your idea? And so I think it's important to really, really cultivate the idea. Not every plant you seed needs to grow. Some of them are bad weeds, but some of them, if you give them the love and attention, will become very good plants that can feed you. And when you think about the idea, you also need to think about what you do with your idea, because you understand what you want to do, but you also need to make sure that the people around you understand what your idea is and why it's a good idea. There's a TED talk that talks about, if you have a great idea and you're on your own, you're a crazy person. And if you have two people, then you've convinced one other crazy person. But if you have three people that believe in the idea, now you have a crowd. Now you have two people that are standing and excitedly promoting what you're saying, and people around them are going, oh, if those two like it, maybe it's something good, and maybe they're going to start liking it. So when you're developing your idea and you're nurturing it, consider how to best present that to the people around you, how to best convey why it's a good idea, why it's a good dream, and how that dream can become a reality, and how big that reality can be. So then you have to ask yourself, it's great, I have this good idea, I know what I want to do with it. Do you have what it takes to actually go out and do it? Because having the thought, my daughter always says that she thought of one of the tastes on Pringles before Pringles did it. And that's great, right? But like her, probably dozens of others thought of that idea. She didn't go and do Pringles. She didn't go and sell the idea of that taste to Pringles. She did nothing with it. So that's not an entrepreneur. What you need to do is actually take that idea and execute on it. And so while we're talking about ideas and thoughts and dreams and being able to get people excited about that idea that you're promoting, you also need to show that you're actually doing something about it and not just talking about it. And then we have the team. So I started out by talking about how you need a few more people that are rallying around you and saying that they're excited and interested in this. The team you're going to be working with are people that you're spending most of your day and nights with. You're going to be with them longer than you spend time with your spouse and family. So you'd better make sure that you can get along with them. And people typically think of getting along as being able to do good stuff with them. I think it's probably even more important to find people with whom you can fight, with whom you can disagree, with whom you can not see eye to eye on the very core elements, but that you can talk to them in a peaceful manner, even when you're disagreeing, and get to an agreement on how to move forward. Because everyone's going to disagree at some point. The question is, how do you deal with those disagreements? And therefore, choosing the right team, the people that when you don't have the energy and you are down will pick you up, and that when they are down, you can pick them up. And more importantly, we often see teams of people that are the same education, same experiences in life. Those make for interesting teams because they're easy to get along with, but not necessarily people that bring diversity of skills to the table. And you do need this diversity of skills. You need someone that can develop the product, and you need someone that can sell the product. Those are not necessarily the same people. So consider that when you're looking at your team. And remember that however amazing and great you are, if you're doing everything on your own and you're not delegating, you're going to have a very, very hard time becoming a large company. You might be successful, but in a much smaller realm. And even Steve Jobs, whom I'm sure we all know was pretty full of himself, even he knew that everything needs to be done in the end by a whole team of people. So I think not only do you need to have the team, the concept of the team, but you need to make sure that you have great mutual respect for each other. So if you think that you're very talented and you're bringing someone else who's okay, it's not going to work. If you're looking in reverse, it's also very difficult. And so the ideal founding team is a 2-person team, because more people becomes difficult. By the way, 3 is fine too. 4, 5, 6 becomes very difficult. If it's 1 person, why is it 1 person? Do you have, a personality challenge that you cannot share nicely? Are you going to be difficult? These are all questions that the investors are going to ask themselves. Why are you on your own? Why don't you have a partner? Couldn't you convince them? Couldn't you work with them? What's the problem? And then there's the middle aspect, right? So I started talking about you want to have teams, you want the respect, but then there's also, are you going to get along? For instance, a team that has a history of working together, you know that they've been through thick and thin together and will get along. And we also often look for similar age and financial standing. This is not a must. There's advantages to that, particularly before you fundraise. Once you've already fundraised, that difference becomes a little bit less critical. Now, why do I talk about this? If you think of someone who's already had millions and millions and all they want is to IPO their company, that's different from the other founder who may not have a penny to his name and is very, very eager to have an exit. And so their interests are not going to be aligned when they go fundraising. So you might want to consider who you're going to set this up with. Do they have the same drive and the same interests as you? Regarding the similar age, it's a little bit of an ageist concept, right? If I am 25, do I have more energy and will to succeed and drive than if I'm 55? Maybe yes, maybe no. Do I have the same ability to invest all of my time and efforts into something? To some extent, right? Because if you think about it, the 25-year-old is probably before children and the 55-year-old is already after small children. So they're somewhat aligned and they can work together. So it's not it has to be the similar age. I think it needs to be more of a mutual respect and mutual investment, time and passion in the company. And that often comes with similar age, but not always. So if you think about what I mentioned before in terms of not everyone should be from the exact same background. Imagine a team of people who are great developers and don't know how to sell. By the way, this is what Israel's high-tech industry started with. We had a lot of very strong technologists. They did not know how to talk to a customer, how to close a deal, how to negotiate. That skill set was not part of what they had, but they'd all been together, grown up together. They were all friends and they went at it all in one shot. I think the companies that succeeded by luck had someone that managed to develop the sales and marketing skill set. And with time today, I think there's a lot of people in Israel that have developed that skill set because they've done it for a number of companies. But in general, and I tell my team this all the time, if we all attend all the same calls and do all the same work and all the same meetings, one of us on their own could probably do almost as good a job by attending that call or doing that, writing that document. But if instead we divide up, we can get more done faster. We can bring different perspectives to things. We can look at things and apply our unique skill sets to them. We are far more likely to be able to grow. So delegation, a broad range of skill sets, and supporting each other are key to being able to succeed in what you're doing. And by the way, VCs, in particular in the early stages, will put a very, very heavy weight on the quality of the team, possibly more than on the idea itself, because ideas change. Now, it's funny that I bring this up just at this slide, because the timing of an idea is important, but also the idea itself doesn't live in a vacuum. The idea is influenced by everything that is happening around it. So the concept may change, but the team will require quality of the team itself. So in terms of timing, and this can bring us back to what I was mentioning about the startup that I set up, Sendum. Timing is very, very important. So if you look at Whitehead's statement here, it says that ideas won't keep, something must be done about them. That implies what we always expect. If you're too late to the market, others have done what you want to do, and you're not going to succeed. But if you're too early, which is what happened to me, it really doesn't matter. You're not going to succeed either. So I preceded the iPhone, I preceded WhatsApp and all the other players in this space. I even preceded Twitter, who had the opposite view of what we were doing, if you will, one person writing to many, but not expecting answers from any. So I preceded all of those companies by about 2 years. And when I came to the VCs, people asked me questions like, how often do people need to write to a group? And I had to show them examples of cases in which we thought it would be something that would be used. This sounds very funny in 2021, right? Everyone knows that group messaging is the norm. In 2005, this was a new concept that people had to get comfortable with. We were too early to the market. 2 years after we founded the company, iPhone finally arrived, and we understood that the world was moving in that direction. But the capabilities of the device were so primitive at the time that it could not support the things we needed. So the Nokia was a lot less cool, but it had much, much greater abilities. And with the iPhone, we knew this was where the market was going, but we had to sit and wait for another 1.5 years, more or less, for the company to finally develop the technology that would enable us to work in sense with messaging and contacts and an app all working concurrently. The initial device just couldn't do it. And when we're talking about ideas and their importance, and this is perhaps why I mentioned that ideas change, right? And concepts are complicated. So the Post-it, I don't know if you've heard this story, and I'll be very brief about it because it's a known story. It was originally a company that was trying to develop a new type of glue. 3M wanted glue. And what they found out is that the quality of the glue that they had developed was just not very good. It kept disconnecting. It didn't hold on tightly enough, until someone realized that this glue that they'd put enabled them to move the notes from place to place because it wasn't glued on strongly enough. And we all know today that these Post-it notes are extremely popular and have become one of the big revenue generators for 3M. So this is an accident that happened to go well in the end. And Panorama is another example. This is a lady, I met her about, I don't know, a decade ago, and she was giving a talk much like the one I'm giving today. And she was telling us how she went from VC to VC, and there weren't many VCs at the time in Israel. And they all told her, what do you even know about this? And how are you going to do this? And no, we're not interested in investing. But she was convinced of the quality of her idea. And she went on to develop it and continued and continued and continued. And eventually her company was acquired. I think it was for several hundreds of millions of dollars. It was a very large amount in any case. And the lady stood in front of all of the crowd and said, and then I wanted to share it with the VCs, but they hadn't invested in me, so I couldn't share it with them, and I took all the money to myself. And she was very cute when she was saying it, but that's an important example to remember, because in the end, the VCs, the smart people, right? They know what they're doing, but they don't know if you're going to succeed or not. In the end, it's a risk system. It's a risk mitigation system. We look at the startups and we go, do we think they're going to succeed or not? We know that a percentage of what we're doing is not going to succeed. And so we're trying to mitigate our risk and bet on the ones that we believe are going to be successful. And she was unable to convince the VCs, but she was acquired for a lot of money by one of the companies afterwards. But remember that the fact that she was in love with her idea and it succeeded doesn't mean that it will always succeed, because everyone's in love with their own ideas. But that does not matter that those ideas are actually going to be successful. And if your idea needs to change and you're not changing it, you're going to fail. I can tell you that when I started Sendem, one of the claims to fame that we had when we sold to the VCs is that we said, oh, you know, this is a serverless solution. You can just set it up, no server in the middle. And after about 2 months of working on this, we got pushback from the entire market because there was some detail that disturbed them in the serverless model. And the conclusion was that for this to be successful, we needed to add a server. Now, I was terrified at the thought of going to my VCs after I told them, you're investing in me because I'm creating this fantastic serverless solution, and tell them, oh, and by the way, we're adding a server. And so we went to the VCs and I told them, listen, I have excellent news for you. And they said, well, what's the excellent news? I said, well, we've decided we're adding a server to our system because it's going to make the technology a lot more complicated and nobody's going to be able to copy us if we do that. So you can imagine that this didn't go down without a lot of discussions around it, but in the end, they got enthusiastic and convinced that the server really was a very good idea. So it's important to move along, to change, to not remain fixated on what you're doing, and to adapt to what the market needs. So you need to be passionate about your idea so you can push it and drive it, but don't fall in love with your idea because it might not be the right idea. You might have the right team and the right investors, but maybe you need to change the product, maybe even change it fully and not just tweak it like we had. And if you think about it, prototyping, which is not that dissimilar to what I just described, is a discussion you have with your ideas. It's something that you try and you err and you change until you get to the right idea. And this is something where it doesn't really matter what space you're looking at. You can be in agri-tech or in health tech or in fintech or in anything else. You need to constantly learn everything that's happening everywhere else, understand your market, understand why you're doing what you're doing, and try to constantly find what's wrong with what you're doing with your ideas to improve it, to adapt it, to get to the best one. And finding that idea should resolve a real need. Now, what do I mean by a real need? You might think that what you're developing is really, really crucial, but if you're the only one that thinks it's important, it's not a good idea. It doesn't solve for a real need. So you need to listen to what the market says, listen to what your investors are saying. Don't constantly just stay fixated on what you believe, because it needs to consider the market outside. And you need to look for a fundable idea. So not every idea that you have can get VC money. Now, and we'll discuss it in a minute, you might not need VC money, but if you are going for it, then you need to understand what the trends are right now. It's easier to invest in something that everyone's looking at because there's money available for that than if you invest in something else. But if you're just saying words, then that's not going to be helpful. So as an example, a few years back, someone came to me and said, I have an idea, I have a company. And I said, great, so what does it do? It says, well, it's a marketplace that's based on blockchain. I said, okay, and what does it do? Well, it uses AI. Fantastic. And what does the marketplace do? Well, it's blockchain-based. And a 15-minute conversation. I cannot explain it to others. Don't just listen to me. Go try it for another 2-3 weeks. Talk to another 5 people. But if they all have the same reaction as me, move on to the next idea. This isn't the right one. But listening to what everyone has to say doesn't mean taking it at face value. And Henry Ford has this famous statement that people would have asked for faster horses. And he's not wrong. Few people have the imagination to understand what it is that they really need. They can probably describe what's disturbing them, but not what they need. And we see this along history in so many cases. Saying Disney doesn't have imagination is outrageous. Firing Steve Jobs from Apple is unthinkable today, but at the time it certainly did happen. FedEx were told that nobody would pay a premium to get speed and reliability. We know that certainly didn't prove itself. And the telegraph was sufficient to send messages. Well, I think even the phone has proven that wrong, but we all know how many other communication inventions have succeeded since. So you have a big dilemma as an entrepreneur. Should you follow your gut or should you answer a need? And the answer is you need to find the right answer within you, because nobody else can tell you how far you need to go, and continue trying and iterating and talking to more investors versus it's just not the right idea and you should move on to something else. It's a trial and error and level of conviction, and frankly also a question of how much can you afford to do, how long can you continue going with something that's not getting traction. The other question you need to ask yourself is your product a vitamin? It's nice to have, but you'll be fine without it. Or is it an aspirin? Your head is killing you. Your customers are going to buy aspirin because they need something to cure that pain. And it sounds like a very smart thing to say, but I just want at the same time to remind you that the iFart application on iPhone was a mega success that made millions of dollars. So sometimes a vitamin is just fine. And maybe we need to look at it also from another perspective. When it came out, there were very few applications on the iPhone. And so they didn't need to offer something great. They just needed to offer something funnier or better than what was available, and there wasn't much available. If you did an application today, you'd have to contend with a much, much higher level of product and marketing than you did when that came out. So what do you go after, a good idea or a good business model? Well, obviously you want a good idea and a good business model. And when you go for that, then let's talk a little bit about SaaS metrics. So this is the Bible for venture capitalists. We look at this as the way to measure the growth and the quality of your startup. And I've just written down a number of these things, and these are all key concepts that you need to master when going to fundraise from a venture capitalist. So we will want to understand what's the lifetime value of your customer. So you've acquired a customer, he's paying you. How long is that customer going to stay with the company and continue paying it? A year, 2 years, 3 years, 6 weeks, right? All of that matters. And you want to also understand what's your cost of acquisition. If it costs you 10 cents to get a client, your LTV could be shorter than if it costs you $300 to get a client. And so you're going to calculate your lifetime value versus cost of acquisition ratio and want to make sure that you have a very good number there. The other thing that we look at is the average contract value. So if you're selling, typically we want to see, and there's variety depending on who you're selling to, but on the enterprise side of things, for instance, we would like to see an average contract value, an ACV that is pretty high, because if you're selling to a company like Citibank and all you can get from us is $2,000, we don't think you have a great product, because that means you've got a very small product when you're selling to the very big companies. You probably have an even cheaper product when you're selling to smaller companies. It's going to be a lot of work for very little value. So it might not be a good company. Now, if you sell to Citi for $1 million, now you have a product that has greater value. But this is also, it's not always the same. So if you sell to Citi and it's just a land and expand deal, right? You get your first small contract, and from there it's growing and growing, and you can show how it will become $1 million, then you're just early and not necessarily with a bad business model. So a lot of these numbers need to be explained, and their quality moves with time. The other thing that we look at is your growth rate. So this 3x, 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 2x, 2x. There's this famous mantra that when the company is very young, it needs to triple its revenue from year to year. So the first 3 years, every year you want to see how you triple your revenue. 100K in the first year, 300K in the second, 900K in the third year, you're doing great. But if you're, and after that, as your company grows, you want to see how you're doubling the numbers. And I went with small numbers here. Of course, we typically want to see big millions because we're very keen on having large exits. Now, why are we so keen on having large exits? Obviously, everyone wants to have a large exit, but the model with which VCs measure how they want to work is actually based on a logic that says, if I invest in 20 companies, I expect, certainly in the early stage, 16 of them maybe to fail, or 10 of them to fail, 5 of them to do okay, and 5 of them to do well, with only 1 of them doing amazingly well. And so when you have those numbers in front of you, you need to make sure that you're investing in companies that have the potential of returning the size of your entire fund. Because you don't expect all of them to succeed, you need the very few that do to make sure that you do 2 or 3x as a fund on the money that you receive from your investors. So when presenting VC is a start cycle of life, if you will. I go and raise money from my investors. I then turn around and invest the money in the startups. And we all need to show that we're doing very well, and we all need to do our 3x on the money. So I will need to make sure that what I invest in has a logical place within my strategic and financial planning. And then the magic number is also some ratio that you need to calculate. And I think before going to see a VC, you need to go through all of this and be able to talk comfortably about each one of those within how you're looking to invest, to make money for the VC. So this is actually a funny slide. The first time I was asked to do a presentation like this was about 10 years ago now. And at the time, I'll tell you honestly, Netflix was on the next slide that I'll show you in a second. So you're saying if your users love it, business will follow. And you see that Facebook, Google, YouTube, they didn't make money originally, even Twitter. Twitter, we can still discuss if they're making money now, but the 3 others have found good business models. Netflix originally was on this slide. Sometimes you get people to follow you and you don't make money. Google Plus failed, Netscape had users but ultimately failed. And Netflix 10 years ago was sitting here. They had managed to displace all of the machines that were offering and the stores that were offering. Actually, they displaced the stores that were offering videos, and they were putting machines in the streets and you could buy videos from there. And it was, they displaced them, but they had users, but they weren't making any money. And when I looked at the slides today, I thought, no, Netflix has moved completely, because if you think about it, as soon as they moved online and they started creating their own content and so on and so forth, today Netflix is one of the most successful companies. So sometimes patience is required. You get the users, business will follow, but not always quickly. So when you're considering your idea, the other aspect is consider, is it a great idea, but it's tiny, or is it a great idea that has enough market that could make it succeed? And what we mean by this is if, 2,000 people will want to use this, then probably it's not a good idea for a VC. Doesn't mean it's not a good idea for you. You might be able to create a company and, make nice money, maybe even earn enough money to make a good living off it, but it's not an investable idea. So you need to consider about where it is and how you're doing. But don't mistake a niche idea for a very targeted idea, because if, for instance, that same product that you're selling to 2,000 people or companies, each one of them is going to buy it for $50,000, wow, you've got a great company and people might be very interested in buying it now, or $500,000 or $1 million. So it's very important to understand if it's a niche product, i.e. something market, or if it's a highly targeted, super exciting product. For instance, a device that only hospitals will buy, but every hospital will want one of those and will pay a lot of money for it. That's targeted, it's not niche, because every hospital needs to have a MRI machine. And also remember that technology is very important, but the best technology does not always win. So if you look at the Betamax versus VHS video technology companies, Betamax is today understood to have had the far, far better technology in terms of the quality of the filming, in terms of the videotapes, etc. But VHS ultimately won that battle. And the reason they won it is because it's very prosaic, but it's a good marketing story, right? VHS lasted long enough for you to be able to record a movie from beginning to end. And Betamax was too short and you couldn't film the end of the movie. So who cares about technology if I can't see the last 10 minutes of the thriller and I don't know who committed the crime or how it ended and did the love story end successfully? I want to see the end. VHS it is, even if the quality is a little lower. And remember that some of the good ideas are pure marketing ideas. No technology at all behind the iPod, if you think about it. They took the existing music that we had and they just broke it down to singles. Singles were being sold before as well, but now they were selling them very cheaply on a new type of technology. It became a very big success story, and it was the end of music technology as it had existed until no more CDs, LPs, etc. was over. The trend called Modu. It was created by the inventor of the disc-on key, very smart guy, and he had decided that he was going to make a tiny, tiny phone that you could then plug into bigger devices based on the type of activity you're doing. If you're going to have a conversation, a video conference, or riding your bike, you need a different shell, but the inside is going to be tiny. He missed the trend completely. He came out more or less at the same time as Apple. Apple went for bigger, bulkier devices than what had existed to date. So if you look at the Nokias, the Samsungs, etc., at the time, they were becoming smaller and smaller in accordance with the trend that Modu was following, making it even smaller. But Steve Jobs came with something much bigger, and he won because he understood that people were looking for a better internet device in reality, a better experience on that front, and they couldn't care less about the smaller aspect of it, as the internet, as the mobile industry has proven. So I guess I want to leave you with this thought. When you have a good idea and you have people that are willing to support you with it, just go and run with it. Surround yourself by strong teams. Talk to people. You'll find that most people, investors, VCs, so angel investors, VCs, other entrepreneurs that have already done it, Seargate, and many other companies are willing to help and willing to give you a hand to try and set things up. So I would encourage you to do it and try and build something new and exciting, because it is probably the most exciting and positive adventure and difficult one that you can have. Thank you.
Thank you, Ornette. That was very insightful.
Thank you.
I'm sure the house agrees because they have questions. I hope you're ready for our questions.
Absolutely.
I think before then, I don't know if Nee has anything to add. Hi, Nee, do you have anything to add?
I think it was well delivered by Onit. No addition. Thank you, Onit.
My pleasure.
I think my favorite thing was the Apple model. I mean, that's always like a surprise to everybody, how Apple just came from like being the underdog to being like the main player. So that was very good.
Completely
okay,
agree.
So quickly going into the Q&A. Our first question is from Lucina. And the question is, for tech startups, could you argue that last mover advantage more important than first mover advantage is more important than first mover advantage from the experience of the Send Me startup of the presenter? That's of you.
So I think it's yes and no. So I think first mover advantage, if you're going to be successful, if your first mover advantage comes when the market is ready to receive you, then that's very important, right? So if you look at a Plaid, for instance, they conquered the US market and they have, a valuation of $5 billion now. So their first mover advantage paid off massively because they really did conquer the market. But if you're going to be very early like I was, and the market isn't ready for you yet, then absolutely it's better to be later, but on time, with the technology that's ready for you and the users that are ready for you. There's no advantage at all to being early. People tell me that's, oh, at least you were early and not late with your startup. And that's only true for my ego, because I wasn't an idiot who missed the fact that everyone was already doing it when I started, right? But from a results point of view, that failed and that failed. It doesn't matter at all if you were too early or too late. What matters is being on time.
Okay, thank you. So I'm guessing the answer to that is depends on your market pretty much. You just have to know what your market demands at the time you want to launch.
I think so.
Okay, so next question. I have a cash amount of Tanzanian shillings, about 1 million, but not aware of what she can invest in her country, in Tanzania. So I don't know if you have any advice on that, on what markets are doing well in Tanzania right now concerning investments.
So I would say it slightly differently. So I have no idea what's happening there, but I'm saying if that's the money you have and that's what you need to live with and earn your money with, think about whether investing it in a high risk industry where 9 out of 10 companies are going to fail is the right one. And if you're going to invest in it, invest in areas that you understand very well, where you can open doors for them, where you can leverage your know-how and your skill sets for this. And don't just go blindly after something that you're not an expert in. So typically, you know, when we invest, we don't invest the majority of our holdings. This is, I'm talking angel investors will typically invest small amounts that will not make them go bankrupt if they're failing. And when you're investing more, it needs to be something that you specifically understand very, very well, regardless of what's strong and big in your own specific market.
Great, I hope that answers your question. So Shada has 2 questions. The first one is, she would like that you expand more on the magic number. And then the second one is, the investor template seems to lean heavily towards the traditional metrics of business. Doesn't this encourage purpose-driven business models?
Can you repeat the second one again, please?
The investor template seems to lean heavily towards the traditional metrics of business. Doesn't this encourage purpose-driven business models?
So I wouldn't say that it's traditional business metrics, because we're investing in companies that are not profitable, right? So we're not looking at companies that are spending less than they're making. We're looking at companies that are making more and more and more, faster, faster, faster. So I wouldn't say that it's traditional. It's, to an extent, I would say that it's a little bit of a monopoly money type of thought process. It's okay that you're losing money. We're going to put more money behind you because you're making potentially more in the future. So it is a very different business model than your traditional business, where if you have a bookstore, you want to not spend more money on the creation of your bookstore than what you're generating, because otherwise you're going to go bust. So it is quite different, and that's why I was talking about the SaaS metrics, which ties into your second question. The SaaS metrics are a way of measuring that you're headed in the right direction, despite the fact that you're not profitable yet. So if you think about it, if I see that if I give you $1 million to spend now on acquiring clients, you're going to make $3 million out of it over time, even if from a technology point of view, you're spending $10 million right now. So I'm ignoring the technology side of things and the cost of building that. And I'm only looking at sales and marketing in terms of revenue and expense. And if you can then prove that you're growing at a rapid rate and a repeatable manner, and the cost of the technology is going to go down, and the cost of the revenue you're generating is going to go up, then I don't care that right now you're not profitable. I can invest in you knowing that you've created this repeatable system mechanism that is generating more and more money over time. The magic numbers, the specific calculation is actually quite complicated, so there's no much point in describing too much of it. It's, you know, the current quarter's revenue minus the previous quarter's revenue times 4 divided by the previous quarter's sales and marketing expense. So it's very technical. You just need to have the numbers, but you can go online, write magic number SaaS, and you'll find the exact calculation explained to you. And I think if you understand those metrics, you'll understand the magic wand that we use to say this is a good company, or this is an okay company, or this is a not unproven company. And because those are really the key aspects with which we calculate the value and the growth of a company.
Thank you for that, Ornette. So the next question, how do you go about shareholding splits with your co-founders for the startup? Any best practice considerations?
So that's a great question. There's no one size fits all. Often we see that when they're really equal partners, then they come and they share equally. But often we also see that there's a serial entrepreneur who's one of the founders, and he's bringing people with whom he's worked that were his employees maybe in the past. But clearly that's, there's the top dog and then there's the two other founders. Then we see very often there that the division of shares isn't equitable. So one might have more and the others might have less. But there needs to be a good reason, because this leads to frustration between founders unless you can really prove why it is the way it is. So if Steve Jobs comes with me, I'll give him more shares. It's okay.
Of course. Next question is by Razak Nuhu Badmus. The prerogative of a successful startup lies in some of the basic components which are scaling up of the business to thrive in the competitive market. Moreover, implementation is another factor to be considered. Implementation is another factor to be considered for optimum profit net working capital. Please, may I use this medium to inquire if there is arrangement on ground for ventures company to take care of these components?
So I completely agree, right? So you have a great idea, but you don't know how to execute. Successful. Great on execution, also same situation.
Hi, I think we lost you there for like a split second. So if you just start it.
Can you hear me? So I'm saying I completely agree with the concept, right? You need to have a good idea that's relatively unique. Coming with something that's this is what everyone else does doesn't mean you don't succeed. You can still succeed, but you need to make extremely well. And so I agree with the person who asked the question that you need to have, first and foremost, great execution, because you need to go after concepts that you have a special advantage over the others, or you need to be able to convince the market that you have an advantage over the others, and you need to do it better, nicer. I think in 2021, the thing that everyone's talking about is you need to delight your customers. And if you delight them more than your neighbor, it doesn't matter if you're doing the same thing, you're more delightful. So you will succeed better. So execution is really important. I completely agree.
Great. Okay, so the next person has two questions at Deyinka at DDG. Is it necessary to have revenue stream before approaching venture capitals? And how many multiples would usually excite them?
So you don't need to have revenue yet. There's different venture capitalists that look at different stages. So if you don't have revenue yet, so let's start from the very beginning. If you just have an idea and a PowerPoint and maybe a team, then you can go to an angel investor or maybe a pre-seed investor, and they will typically invest in these stages. If you go with this concept to someone who's a late stage investor, they're just not going to invest in you. So the revenue question comes at the point where you're going to usually between round A and round B, people start looking at revenue as opposed to looking at technology and team and things, an idea and things like that. So it really depends what stage you're at. And I think you need to remember one more concept, that if you've developed all of your technology, but you haven't proven your sales and marketing yet, that is probably the hardest stage you're at. So you want to raise money before that, when you still need the money for the technology, because otherwise, if the technology is fully baked and all that's missing is sales and marketing, typically VCs will not want to go in there until you prove that you have something exciting and successful. It's the hardest point at which to raise.
Okay. Thank you. Okay, his next question is, he basically wants to know more about how the seed capital series work. So he wants to know where it applies and how we basically, like, we just always hear about this company raising seed capital for Series A. So he wants to know how that works and how it applies.
That's fair. I can give you a variety of theories, but in practice, what happens is you need to meet people that have capital to spend. and that gets excited about you and what you're doing. So these people need to think that what you're doing is the right type of product for them, that they would want to be a partner with you. So when you raise money, you're raising money from someone with whom you're going to be in touch for somewhere between 5 and 10 years. So they need to want to spend time with you. You need to charm them that they want to work with you and spend time with you and help you, and maybe roll up their sleeves if that's their DNA, and you need to let them in so that they can work with you. Or maybe not, right? Some investors want to put their money and just be updated and not have to work for it. So all of these are legitimate ways of doing things. When I went to fundraise, it's actually a funny story, and I see it's live on Facebook. Too many people are going to hear these things about me, but here goes. I went to investors and they kept telling me, oh, you know, this, how much you want to raise? Let's say $500,000. We're going to bootstrap it. And they'd say, oh, you don't know what you're talking about. For your space, you need at least $5 million. Fine. So the next investor, I'd go and I'd say, I want to raise $5 million. And they'd say, what are you talking about? You need to bootstrap it, 500K, not a cent more than that. And, you know, the first time you feel stupid, the second time you feel stupid, and then the third time you go, okay, I'm done with this. And so I had 3 decks, one for 500K, one for 2.5 million, and one for $5 million. And I'd spend the first 10 minutes talking to the investors and trying to understand what their DNA is. I'd chit chat with them, talk about other investments they did, understand how big of a check they have, understand what type of involvement they want. And only then would I open up my computer and open up miraculously the deck that had the amount that I already knew that the investor would be interested in investing. So if the person told me, I love bootstrap companies, 500K is my favorite ticket, I'll open the 500K deck. And if they say, oh, we invest $5 million, maybe $4 million, well, I'll open the $5 million deck. And so I think when you go to fundraise, think about it like a sales pitch. You're going to try and woo the person on the other side to want to work with you, to want to spend time with you, and you want to come to them with a story that's compelling. So if you're going on a date with someone who wants to get married, say you're in a one-night stand, but if you're going on a one-night stand, don't start talking about the size of the diamond ring that you want to have on the other side. You have to understand who the counterpart is and really come with a story that makes sense for both sides.
Great, I think that pretty much covers that. Question by Jide Meadows. What role does incorporation play in seeking venture capital funds?
So if you're coming in really, really early, you don't have employees yet, you don't have a team, or you have an initial founders team, and you're talking to angel investors, it might not matter that you're not incorporated when you start talking to them. Before they put any money in the company, they'll expect you to incorporate. But incorporation should be something that's relatively cheap and simple. You know, it shouldn't be a major hurdle for you. I don't expect that you'd be able to receive money before that happens. But it doesn't need to happen much earlier than that, right? It can be something that you do at the last minute.
Great. Okay, so the last question by Adegbenga. He wants to know why animation companies are not getting funding. So maybe they need to position themselves better, but he wants to know why that is.
So not my space at all. So I don't know. I would imagine that it's a question of market size in the end, that it's exciting for people to invest in places where they feel that they're going to make enough revenue out of that investment. So usually when you're asking those questions, you know, ask yourself, where's the money? Why is someone investing in something, and what are they expecting to get out of it? And if they're not putting money in that space, likely they cannot convert it to something that would be a sufficient revenue generator. But I'm saying this as a philosophical thing. I don't know specific about animation companies, I'm afraid.
Okay, Onit, I think one of the earlier question by Yinka, right, was he wanted to know how does a series work? And what qualifies for Series A, Series B, Series C,
okay.
Like how this series model.
So it used to be quite simple that people would say a certain amount of money is equivalent to a certain series. So typically like a seed round would be 1 to 2 million, and the Series A would be 3 to 5, and so on and so forth. But the world has shifted on us, and the numbers have run away. So I'm now seeing seed rounds of 10, 12 million. So I want to try and define it slightly differently and more about stages. So I think if you come to someone with a PowerPoint and 2-3 people, typically you'll raise something that's more tantamount to a pre-seed, maybe a seed round. As your company grows in its ability to define what it's doing and its execution, you might be raising $2, $3, $4, $5 million now as a seed round, sometimes even, as I said, 10 million. And those are typically rounds where you're defining your product, you're going to the market, you're doing some A/B testing with it, you're starting to develop the product a little more. Your A round is often bigger, of course, but it's often when you have a first product that you're making it available for POCs. You now have something that customers can start engaging with, can start trying it out, and seeing where things are going with it. And B rounds are usually when you already have some revenue. And after that, you're in growth rounds that are just, how much more money are you making? And you're raising as you're making more. So there's no clear, I'd say a C round, you'd be expected to usually have probably a 10 million ARR-ish. But I've seen companies that have done more or less, etc. So everything I'm saying are guidelines, they're not rules, and it's not always exactly that way, but it gives you some form of understanding of where things are at. And I think if you're growing very fast, then ignore all the numbers I've said and everything will get pushed ahead. So if you're growing really, really fast, then it doesn't matter that, one of the companies in Israel now had small revenue, but raised money at a valuation of over $1 billion. And the reason was that they got to that small-ish revenue at such a record speed that everyone was awed by their success and was willing to give them a crazy high valuation. And they're executing on it. They really are selling like there's no tomorrow. So it makes sense to have that valuation.
Thanks.
Is that helpful?
Yeah, thanks so much.
Thank you. Okay, so one final question before we close. For a company that needs licenses to operate, but doesn't have the funds for those licenses, is it okay or is it advisable to ask that investors be part of the funding to get those licenses?
I think it's expected. It's more than okay. So you need to understand what you're bringing to the table beyond the license. But it's absolutely okay that your business model revolves, and the barrier to entry, right, revolves around those licenses. And that's what's going to differentiate you from the other companies, and you're fundraising in order to achieve that. So as long as the story is logical and you understand what you're doing and how you're doing it, raising money to be able not just to fund the licenses, but also to go through the entire process of applying for them is completely legitimate.
Great, I think that answers the question, and that would be the end of this webinar. Thank you so much, Ornit, for taking time out of your very busy schedule.
Thank you for having me. I was delighted for this first experience and hope to come visit soon.
Definitely, we should definitely do this again soon. Thank you everybody for joining. The recording is going to be available afterwards, so you can always play back for the question and answer. And if you also missed Ornit's session, you could also watch that again. This was hosted by Servit. So if you need to know more about us, please go to www.servit.com, and then all the information you require will be there. We will obviously be hosting this again. It is a web series that's going to happen again, but we will be in touch accordingly. So thank you, everybody. I hope you have a splendid and productive week.